Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Domenic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Domenic Rinaldi.
The capital markets for business acquisition loans are open and active, and SBA-backed lending has become a primary source for deals when the loan amount is $5 million or less. However, having a buyer and seller both qualify for an SBA-backed loan can be tricky. Our guest today, Paul Liles, is the managing director for the SBA program at CIBC Bank. CIBC is the fifth largest bank in Canada, and with its acquisition of the Private Bank of Chicago in 2017, it has risen to the top 10% of all SBA lenders in the U.S. The CIBC SBA Group, led by Tom Doherty in Chicago, with Paul Liles as the SBA guru, have become a major factor in the SBA lending world. Prior to joining CIBC USA in 2012, Paul was with the business banking units of JP Morgan Chase and US Bank. He has spent most of his career helping business owners scale and grow their businesses through sophisticated banking instruments and acquisition loans. We will be talking with Paul today about his experiences helping buyers and sellers secure SBA lending and the ins and outs of this type of loan. I've also had the opportunity to get to know Paul on a personal level and know that he's an avid outdoorsman. We both share a love for fishing. But probably the most fun that Paul and I have had is the opportunity to be in an annual golf outing. We are undefeated. What do you think about that?
Yeah, it's hard to find anybody to beat us yet, even though I would rely on your golf skills more than mine.
You know, we happen to play against the two same individuals. So it's Paul and I against these other two guys every year. And one of them actually, I think, practically lives at the golf course, right? Wouldn't you say?
Yeah, I think he spends more time on the golf course than in the office.
And the other guy hosts clients all the time at the golf course. They don't give us any strokes, and we're undefeated. It's perfect. It's great. It's justice.
It's very, very sweet justice indeed.
Hey, Paul, thanks so much for joining me today, and so excited to dive into the world of SBA lending. You know, I think the obvious place to start here is maybe you could explain to everybody what is an SBA loan, because I think a lot of people think when they're applying for an SBA loan that the SBA is actually loaning them the money. And in fact, that's really not the case.
When it comes to the SBA, basically financial institutions such as CIBC, we are SBA lenders. And so we're basically lending that money out to our borrowers. It's not necessarily the SBA lending any of those funds out to our clients. They're more or less guaranteeing the loan, and typically up to 75% of that loan is guaranteed by the government through the SBA program. And we're more or less, again, 100% or 90% financing of that potential acquisition or that other SBA type facility.
So I got this right, and the listeners understand this. A buyer comes to you and they want to borrow some money. They can get typically 90% of whatever loan amount they need, up to $5 million. And then the SBA is covering 75% of that, meaning if something were to happen or go wrong with the loan, the SBA is then covering that?
Correct. So really when it comes to the SBA, there's three main reasons that you're typically looking at an SBA opportunity or for financing. Number one reason is usually there's a collateral shortfall. So traditional bank financing wants, 100% collateral coverage to secure the loan, whereas SBA does not require 100% collateral. You still have to at least attempt to fully secure the loan. But then the other main reason is a 10% equity contribution is the minimum that is required of our borrower, whereas maybe traditional financing, you're talking about a much higher equity downstroke in order to get kind of conventional financing. So it makes it more advantageous from an SBA perspective on the equity portion. And then the other piece, the third piece is the longer amortization that the SBA allows you to, or the term of the loan. that the SBA allows you to extend out for financing. On most acquisition deals, excluding real estate, you can go up to a 10-year term or amortization. And that's a lot longer than typically what you see on the conventional side. So it's a great tool for people that are looking to acquire a business to get financing outside of putting all the cash down or 100% seller financing in order to make that acquisition and use this SBA facility. And from a bank standpoint, we have that 75% guarantee from the government, which allows us to obviously feel a little more comfortable from that lack of potential collateral or stretching out the term of the loan.
Yeah, so you talk about collateral. Let's spend a minute talking about that so people understand. In a conventional loan, the banks are looking to make sure that they've got most of that loan covered with some sort of hard asset, right? And in the SBA,
Correct.
that's not the case. So the SBA allows for what we call a lot of goodwill lending. As much as probably what, Paul, do you see? Maybe sometimes 80, 90% of a loan can be goodwill in some cases?
Yeah, I would definitely say especially with acquisition financing, typically most of the transactions are going to have a very large portion of goodwill. In certain industries, you may have some specific hard assets, equipment, you may have some real estate involved, but usually when somebody's acquiring a business, they're buying the goodwill or the intangible assets of that business. So I would definitely say in most transactions, you're going to see a good portion of that being goodwill.
Yeah, so SBA really becomes a great vehicle when there really aren't those hard assets.
Correct.
So Paul, I'm just curious, you've been doing this a long time. This is probably just a stab in the dark, but how many deals do you think you financed in your career?
In my career, that's a great question. I would say typically in the acquisition field, what we're usually doing is about 3 to 4 acquisition finance deals a month. So I would say take the last 5 years, you're maybe looking around 100, 120 transactions on the acquisition side.
You've seen and done it all. I mean, you got tremendous experience in this area. Let's take it from two angles. Buyer looking for an SBA loan is going to need to meet certain requirements, but the seller also needs to understand what the SBA is going to be looking for. So why don't we start from the seller side? You have a seller that wants to, sell their business. What do they need to know about their business being qualified for an SBA loan? Even though they're not having to qualify, the buyer is, but it's important the seller understand this, because if their business doesn't qualify, no buyer is going to get a loan to buy that business.
That's correct. And I would say that the biggest thing that we've learned, I guess the lessons learned from doing a lot of transactions, is the best advice that we can always give somebody who's looking to sell their business, whether it's somebody out in the market or even some of our own clients, is really getting your business prepared to sell. And by that, we mean getting your financials in order, cleaning up your books, going through and trying to see from the eye of what the bank is going to be looking at. And what the bank is looking at is what are those add backs that we can build into cash flow to make that transaction work. So a seller going in, meaning they're looking at their books, they're cleaning up if they're paying a lot of personal expenses out of the business, a lot of hard to track and follow expenses that are embedded into the P&L or into their balance sheet, and really looking over. We always say try to give yourself 12 months to even 2 years to really clean that all up and make your books show as much cash flow in the business versus taking it out for potential personal or for tax purposes. And that's really the biggest thing that we see is getting that prepared so you can get the highest, value or multiple for your business, and also show that potential buyer and the bank how much cash flow is truly embedded in the business.
There's a couple of things that peel back the onion on that. So first, you talk about add backs. A lot of people might not be familiar with that term. Maybe explain that a little bit more to our community.
Sure. When it comes to add backs, so a bank is typically going to be looking at what are the sources of cash in the business. So the typical add back that a bank is looking at when we're looking at how much money is coming through the business would be, if you're selling the business, how much salary is the current owner taking, is the seller taking? Do they have, family members that they're also paying salaries? Those are usually the easiest things to add back because we can see W-2s and prove that those, salaries won't be as part of the new owner's business. As well as we're looking at certain things like the amortization expense in the business, depreciation, interest. So those are kind of the main things that we're looking to add back into our cash flow. But then there's the kind of unforeseen or the not so typical add backs that we're looking at. And that may be if they have, specific one-time expenses that won't be affecting the future cash flow of the business. If they're paying, some of their children's tuition out of it, or if they're paying some other large expenses not related to the business, such as large charitable contributions, tickets to, sporting events. So it's a lot of items that you're looking at and saying, is this going to be a need for the new person coming in and acquiring this business? But we also have to take into effect what is considered a true add back that a bank can get comfortable with.
At the end of the day, you're trying to do is figure out what we call it owner economic benefit. I know the words and the terms can get interchanged, but owner economic benefit, seller's discretionary earnings, adjusted EBITDA, oftentimes those can be interchangeable terms. But having that be, if you're a seller of a business, having that number be as high as possible and as provable as possible is so important to achieving the highest value possible.
Sure. And as far as that's the ultimate game, is to make sure that we're taking back all those potential add backs. And obviously the seller is looking to, maximize the cash flow of their business for themselves, for their business. And then when they look to sell as well, get as high of a value or multiple for it. And what we're looking at is proof of those add backs. So we want to see verification and documentation in order to, not just from an SBA and a bank's perspective to build into our cash flow, but also from a valuation standpoint, need to be able to find the documentation to support those add backs. And the big thing I would say is we call them questionable add backs. And sometimes when we say that, it's in regards to if all the personal expenses, such as their cell phone bills, certain insurance bills, and dining, travel, entertainment, a lot of those are hard to prove out, even with documentation, that it was for business purposes. And usually we're saying, okay, if we take those kind of questionable or not so verifiable add backs out, do we still have cash flow off of the kind of normal and customary add backs? And that's what we're typically looking for.
Sure. And then what comes down to the actual financial statements that the bank's relying on. So you've got P&Ls and the balance sheets and the tax returns. When you're looking at a deal and you're underwriting, which financial statements really mean the most to you?
What we're typically looking at, not just from bank's perspective, but also the SBA prudent lending requirements, is we're usually looking at the last 3 years of business cash flow. So we're looking at business tax returns. We're also looking at the financial statements as far as profit and loss, balance sheets, accounts receivable aging, payable aging. And we're really taking in all that information. We're matching up to see what we're seeing on the taxes and what we're seeing on the financial statements makes sense from, are we missing certain add backs? Are we not deducting certain expenses? And it really gives the bank a more clear analysis of the overall kind of condition or health of that business.
Paul, if there's a disparity between the internal statements and the tax return, does one trump the other at the end of the day?
Typically, it depends bank by bank, but for the most part, we're looking at the tax returns to start off on a historical basis. But where you may see sometimes a discrepancy or you're going back is if somebody's doing cash versus accrual accounting. A lot of times you'll see that they have on their tax returns a cash basis tax return, and then their financial statements are accrual. And it's really trying to understand that business and when they're recognizing revenues and expenses and in which years. And that is one thing that we always look for in working with our borrowers and the seller, is making sure we understand the flow of cash in the business and when it's received and when expenses are paid.
In our years of experience in doing transactions, the thing that we tell our clients is most banks at the end of the day are going to rely on your tax returns. When there's a discrepancy, all things go back to, what did you report to the government?
Correct.
Paul, is there anything else from a seller's perspective that you would advise them to pay attention to, whether it be the financials or even beyond the financials, things that they need to be thinking about to make sure that their business is qualified for an SBA loan?
Yes. One thing I would definitely advise and recommend anybody who's looking to sell their business is to make sure, if you're looking whether it's a year or 2 years down the road and that's the plan to sell your business, make sure you get the right advisors and the right staff put into place to help guide you through that transition. And when I mean advisors, working with your partners on the broker side, such as Sun Acquisitions and Domenic, who do a fantastic job of preparing clients to sell their business.
Well, I appreciate that plug. Thank you very much.
Well, you do a great job. So we definitely recommend using your services to get the business prepared to sell. And the reason that's so important is there's a lot of things that, an institution or partner or advisor can prepare that business, such as the financial reporting, if there's some advice on what you should be looking at to sell. Because the biggest thing is everyone thinks their business is worth a certain dollar amount. And whether that's high or low, you can have a partner come in and an advisor to tell you, this is what the market looks like. Here's the multiples. If you're looking to get X, here's how you need to get to that point. And so working with your advisors from a broker standpoint, from an insurance, a tax perspective, and just being truly prepared for that gain in that life-changing moment when you sell your business.
Yeah, that's great advice, Paul. And to the M&A Unplugged community, really, again, this is a common theme. Having the right set of advisors who specialize in M&A transactions can really make your transaction so much more profitable. You can really maximize the value by having the right people involved to advise you every step of the way. Let's shift over now to the buyer side. So you've got somebody who wants to acquire a business and they're going to come to you and try to secure a loan to make that acquisition. What should buyers be thinking about?
So I think the big things buyers should be looking at is, so they've identified and they see a potential business that they want to acquire. Now the next step is making sure that get the financing put into place. And one thing I would always tell, whether it was working obviously with CIBC or another financial institution, is make sure that the lender on the SBA side is a preferred lender and does a lot of acquisition financing and really knows the structure that the SBA requires and the pitfalls and the good things that come with it. So I would always say, make sure you're working with a lender that knows how to put these transactions into place and to be eligible.
For people who don't know, can you just talk a little bit about there's preferred lenders and then what else are there out there? So what's the distinction that people should be looking for?
Yeah, so there's typically two types of lenders. There's lenders who can go through the preferred lending process, where they've done enough transactions in the SBA community that the SBA says, you know what, we trust the decisions that you're making. You've done enough and you know the eligibility and qualification standards. So we're going to allow you to make your own credit decisions in-house. So rather than sending it in, which a non-preferred lender would have to send in their entire credit write-up, all the documentation into the SBA and get the SBA's approval, which is another great resource. But if you can go through a preferred lender, you don't have to circumvent all of the SBA direct communication. You can work directly with that lender, and they're making the decisions, creating the authorization for approval through the SBA directly at the bank.
And so are the benefits of doing that, the loan is going to be a shorter period of time to get the loan through approval and underwriting?
Correct. So if you're working on a preferred lending provider, then they're making their own credit decisions in-house. And also, we're able to turn around from an approval standpoint. We're actually going to the SBA through their online capabilities, and they're giving us an approval number. So it's almost instantaneous from the SBA's perspective, from an approval on a preferred lender status. And versus if you were sending it in directly into the SBA, depending on backlog, if there's any sort of government shutdowns per se or any other backlogs involved, it could take potentially another 30, 40, 60 days, just depending on the workload directly at the SBA. So you're typically seeing on acquisition financing, I would say on average 45 to 60 days from start to finish on a turnaround time if you're going through a preferred lender, versus it could be potentially 30 days or longer if depending on the workflow of the SBA if you have to go directly to them.
Yeah, that's such a good point, because for our community out there, we always talk about how important speed is in deals. And when you add another 30, 45 days, you add all sorts of time for other things to happen or go wrong. And so adding that extra time really could put your deal in jeopardy. So you want to be definitely looking for a preferred lender. Paul, what else, as far as the buyer process goes for securing an SBA loan, would be important for folks to know about?
Yeah, I would say the other kind of important structural things to keep in mind when you're looking to acquire is the SBA, as I mentioned at the beginning of the podcast, one of the reasons why you would typically look at SBA is that equity contribution. The SBA and acquisition financing is typically looking for at least a minimum of a 10% equity contribution on the total proceeds of that transaction. And so just making sure that you have, the equity, the funds available. The SBA is only saying that we need to be able to verify equity. That is one of the biggest pieces. So if you're looking to acquire the business, make sure that 10%, talking with your lender and getting that information, putting that somewhere where we can verify 2 statement cycles of all that equity that's going in. The hardest part is if you're looking to go around and try to find money from different areas and you're getting close to close, that's where things can get a little challenging and push time back, because you don't have a lot of that documentation already prepared and ready for when you're looking to get the financing.
So let's put maybe some numbers around that. So if you're looking at a $2 million loan, what you're saying is that people need to have at least $200,000 in liquid or readily available funds for that 10% of the total purchase price.
Yeah, and it's not technically off of the purchase price, it's off of the total proceeds. And the reason they put that into place is the nice thing is with the SBA, they do allow you to build in all your closing costs, third-party costs, any fees associated with the transaction can actually be built back into the loan. And then once you build that all into that total project, the SBA says, okay, now we want you to have 10% of that total project cost. So say it's a $2 million purchase price, and then there's some other fees involved in there. They're saying, take whatever that total loan amount is, or total project cost, and we want to see 10% equity. And so if you just say a flat, everything all in is $2 million, to your example, yes, make sure you have around $200,000 in cash, liquid cash, whether marketable securities, in your savings, your checking, and a 401k that can be, pulled out and rolled into the business. So those are things that you want to make sure you're ready for preparation of that equity contribution.
Let's talk about a few other things as it relates to buyers. How does transferable experience or relevant experience play a role in how you underwrite these SBA loans? And, what kind of collateral or security is a buyer expected to provide on an SBA loan?
One of the big things that the SBA has as part of their required documentation, and also from a bank's prudent lending practices, is looking at the transferable or relatable experience of the new buyer coming into that business. And so what the SBA is looking for is what skills or direct industry experience does that person coming in to buy that business have, in order to make sure that it's a successful transition and that new owner will be successful. So meaning that, say you were in the technology world for 20 years and then you wanted to own a pet store and you don't really have those transferable skills, SBA is going to say, well, why did the lender give you financing if the business fails? They're going to see that there wasn't direct correlation to those skills transferring over to the other business. So you really need to be able to look, if you're acquiring a business, do you have management skills? Have you run a business? Do you currently own a business that you can say, I've taken from management top down and I can do the same thing into this new type of industry? Or if you have direct industry experience, that's even more preferable, saying, I've been in this business for the last 5-10 years and I can directly translate to me running this successful business in the future. So that's always a key in making sure that you have that experience and that we can state that case to the SBA why you're a qualified potential borrower. And then to answer your second part there, Domenic, in regards to the collateral, personal collateral, one of the other requirements of the SBA is, even though the SBA program allows, it could be potentially 100% collateral shortfall on the loan, the SBA does require lenders to at least attempt to fully secure the loan. So once we look at all the business assets and we build that into our total collateral pool, if there's still a shortfall from a collateral standpoint, the SBA then requires us to go to our personal guarantors, and anybody who has more than 25% equity in their personal residence, whether they're primary or investment, and they're 100% owner of that piece of real estate, we are required to take that and pledge that as additional collateral to the SBA per their requirements.
So a buyer needs to understand that they're going to have to sign a personal guarantee.
Mm-hmm.
And then to the extent that they have other hard assets, real estate or whatever, they're going to have to pledge that if there's a collateral shortfall.
Correct. And the SBA determines from a guarantor, personal guarantor, is anybody who has more than 20% ownership in the company will have to be considered a personal guarantor. Now, other people can obviously offer their guarantee if they would like to, but that's kind of the minimum of the SBA. And so we're looking at, when we say hard assets, it's truly real estate. Years ago, there was a requirement in the personal liquidity test that if you had other cash, marketable securities, CDs, you were required to pledge it. And they had taken that away to where now it's just specific to personal real estate.
So just on this personal guarantee issue, so if you had 3 owners, let's say, and each held 19% of the company, and the third partner had the balance, those 2 that have less than 20 would not have to provide personal guarantees, and only the person with the majority would have to guarantee the loan?
That's a good question. According to the SBA SOP, which is the standard operating procedures, the requirement is anybody more than 20%, 20% or higher is required to personally guarantee. Technically, those individuals under 20% are not required. Now, one of the things that the SBA does say is if in cases where it looks like you're putting individuals just under that level in order to avoid personal guarantees, the SBA could then say, well, you need to add them as personal guarantors. But in most cases, if you are under 20%, you are not required to personally guarantee. I say that because it is a case-by-case basis in certain circumstances, but for the majority, 20% or more, you are definitely putting your personal guarantee on there.
So anything else that you would advise buyers to understand as it relates to securing an SBA-backed loan?
The one other thing I will say, and kind of going back to the equity standpoint, and when we're looking at transactions, up to $5 million for the SBA lending, the equity contribution of 10%, that can be significant, right? And a lot of transactions, what we even see is that 10% equity, say you're looking at a $5 million transaction, total project cost, and $500,000 is that minimum requirement. Well, maybe the buyer, it's a great fit, it makes sense from buyer and seller, but they don't have that full 10%. One thing to keep in mind is there is, with that 10% equity, a rule within the SBA that you can split that up, meaning the borrower has to, at a minimum, put 5% of their own cash equity into the transaction. But the seller could, in turn, on that remaining 5%, put up a seller note, part of the equity contribution, to make up the remaining 5, or to get to the full 10%. Now, the one caveat of that 5%, if it's seller financing, it does have to be on full standby for the life of the loan in order to count towards that equity. But we have been able to get some transactions. We did a transaction actually last year where the purchase price was $6.8 million, which is well above that SBA threshold. But we actually did around a $4.8 million SBA note. We had 5% equity coming in from our borrower, and then we had 5% coming from the seller on the full standby for 10 years. And then there was a remaining note, a second seller note that had normal payback terms that obviously allowed for cash flow to support it, of around 1.7 or 8 million, that allowed us to do a larger transaction. It's not just small transactions, and to still fit into the SBA mold and to hit all the different parameters and eligibility requirements of the SBA.
Wow. So that borrower got into that $6.5 million deal for $250,000 of equity. Is that right?
Correct.
Roughly?
Roughly around there. Yep.
Wow. And so you used a term here. I want to make sure that everybody understands this, because it's a term that I don't think people hear a lot. You use the term standby.
Mm-hmm.
Yeah, as it refers to the seller note. So the borrower put in 5% equity cash into the deal, and the seller took back a 5% seller note, and you use the term standby. Can you explain that?
Sure. And when we say standby, it means that there is, and full standby is what the SBA requires if it's part of the equity. And full standby means that there is no principal or interest payments allowed on that seller note for the life of the loan. So you'll see a 10-year full standby, Seller note means no payments to the seller for 10 years or until the SBA note is paid in full. And then they'll allow for payments on that remaining loan amount, obviously.
And so why is that a requirement for the SBA?
The reason the SBA put that into place is a little over a year ago, they actually had in place where, depending on the goodwill amount of the transaction, a lender, in order to do it on preferred status or preferred lending status, had to have a 25% equity injection as part of the transaction. Well, the problem is there was a lot of seller financing involved and equity that was coming from the borrower, and it got very confusing and there was a lot of gray area. And so they eliminated that a little over a year ago to where it was just 10% minimum equity contribution. And if in order to, obviously we would like to as a bank on most cases, and so would the SBA, have 10% fully by our borrower. But in order not to limit certain strong situations where there was a great buyer and seller synergy there, is really allowing this seller financing to make up for that other 5%. But as long as there's no payments on it, the SBA considers that true equity because it's not borrowed funds. It's a true equity that's not paid until after the loan is paid off.
Yeah, so I would imagine this term, if we have any sellers, potential sellers out there that are listening to this episode, you're thinking, oh my goodness, I've got a seller note that's sitting out there and I can't receive any payments for 10 years. I just want to make sure you understand that that is only when the buyer is not putting up 10%. If the buyer were putting up 10% of the total loan and you had a seller note, you can receive full payments on that seller note day one. It's only when your seller note is a part of that borrower's initial 10% that you'd have to be on standby. So I don't want potential sellers out there to be thinking, oh my goodness, I would never allow a buyer to go to the SBA and secure a loan that way, because that's really not the way most loans are done, correct?
No, most loans aren't done in that case. I usually throw that out there as kind of a one-off. There's different structures. If you still are trying to get a deal or an opportunity transaction completed, there are ways to do it outside of that 10%. I would say a majority, probably 90+% of all transactions, the buyer is coming in with the 10% minimum. In a lot of cases, there still is seller financing as part of that transaction. Say probably about a good half of the transactions we do still have seller financing outside of that 10%. But as Domenic was mentioning, as long as the payment terms, and analyze that into our cash flow, as long as the cash flow isn't hurt and it supports it, you can set up the seller notes with however you want to structure outside of that 10% to allow for payments sooner, or with different interest rates and amortizations on that.
Well, look, it's that structure of that deal that you just described, $6.8 million. And, it sounds like everybody got creative and hopefully it was a good outcome for everybody, and certainly creative on the bank's part to be able to, pull a structure together like that.
Yeah. And that's, the great thing about the SBA program is, yes, there are guidelines and structure and eligibility that we absolutely have to follow, but there's a lot of flexibility that the SBA gives us in those rules, especially from acquisition financing, to allow the small business community and small business borrowers to, acquire businesses without either having to put all their cash into the transaction, or having to do all seller financing, or even we see a lot of lower middle market kind of private equity that's coming down into this space. It allows a buyer to come in and acquire a larger business without having to give up ownership interest as well. So it really is a good tool to allow borrowers to come in and to acquire a business and really getting a loan based off of cash flow lending and not asset lending.
Yeah, it's great. Boy, we covered a lot of ground, and this is great information. I've been doing this a long time, and I've got over 300 M&A transactions under my belt. And the one thing I know for sure is when it comes to SBA lending, if you don't have pros involved in the transaction, you are in trouble. And I consider Paul to be one of those folks. You and CIBC have been wonderful partners in the transactions that we've been able to do together. You guys know what you're doing. You're always looking to see how you can help the parties get the deal done. You're creative, you're responsive, and it's been a real pleasure. And, Paul, as we wrap up here, is there anything else that you think from an overarching perspective that you would advise, whether it be a borrower or a seller, about the SBA, or is there one key takeaway that you think is important to pass along?
Yeah, I would say from both buyer and seller, kind of one thing to take away is, and we've talked about it throughout the podcast, was that if you're looking to sell, just again, make sure that you're preparing and you're putting in the time, whether it's 6 months to 2 years, to get your business ready to sell, and working with your advisors. And likewise, on the borrower side, make sure you're working again with your team of advisors and, a preferred lender, attorneys, accountants, to make sure that the transaction obviously makes the most sense for both parties involved, and that you're looking and putting a lot of thought into it and working with the right advising team.
It's awesome. Thanks, Paul.
Absolutely.
Hey, one last question I'm asking all of my guests on the podcast is, I'm asking people if it's a business book. Doesn't have to be a business book, but is there one book that you've read that has really resonated with you and made a difference for you in your life?
I would say from a business standpoint, one book that I think I can always go back and relate to is 7 Habits of Highly Effective People. Yeah. Stephen Covey. It's almost one of those, if you go back, it's a refresher, right? You get caught up in your daily world, and whether it's personal, business, and it's always good to read and see that, you need to be, more proactive. You need to put your goals ahead of, other tasks that aren't going to get you to be as most effective as possible, and just really prioritizing whether it's your work, your personal life, and coming to a place where every day you're doing the things that make the most sense for you to grow as a person, as a business person, and really be effective and successful.
Man, I remember that book. I remember reading it, and that man, what a franchise that became. There was a whole franchise that spun off of that. I remember there was a daytimer system that came out of that. I think I used that for a while back. God knows, back in the 80s or 90s. It's a great book.
Like 25 years plus, right, of experience.
I wonder how long it was on the New York Times bestseller list too, because it seems like that thing was on the bestseller list for the New York Times forever, right? I mean, you'd open up the paper every week and it was like, there it is again.
Yeah, no, it's funny because you read the book and you read the terms, and it's stuff that we all know, but it's always good to see it from a fresh perspective, or, even an old perspective, and correlate it to your life and business, and obviously on the personal level. So
yeah, that's great. Well, Paul, really appreciated you having here. This subject matter can get intense. It can get very technical, and glad that we have people like you, bankers like you, that really can help people through the process. Folks want to get in touch with you if they have questions about SBA loans. How can they reach you?
Yeah, so the best way would be either through phone or through email. My direct telephone number at the bank here is 630-488-3007. And my email is Paul, which is PAUL .Liles, LILES, at CIBC.com.
Awesome. Paul, thanks again. Really appreciate it. And, just to summarize a couple of the key highlights that we heard today, SBA loans can really make a lot of sense in the right cases. Some of the attractive elements of an SBA-backed loan are clearly the term, 10 years. And sometimes when you have real estate with the loan, you can take the loan out for the business and the real estate even for a much longer period
Correct.
of time. The fact that you can finance goodwill, you can't do that in a conventional loan in many cases. And with the SBA, they'll do a lot of goodwill, and it's a great way, especially for service-based businesses or businesses that don't have a lot of assets, and the majority of the value is really in the goodwill. And then from a buyer's perspective, the fact that you can get into an SBA loan for such a small amount of equity injection, as small as 10%. So these SBA loans really can be very beneficial for both buyers and sellers. Highly recommend, as you heard today from Paul, that you engage the right advisors, you talk to the right people. For sellers, so important to make sure that your business from a financial and operational perspective is really prepared to go through the scrutiny of the approval and underwriting process. And for buyers, make sure you're paying attention to your background. Do you have relevant experience? Do you have the cash infusion, and do you have the right team? You always want to be looking to work with a preferred lender if time is of the essence. And in most deals, it is. So again, we thank Paul for being with us today. All of today's information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website at sunacquisitions.com or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.